Breaking news. The U.S. Federal Reserve has just cut interest rates. The Fed dropped its key rate by 0.25%, whether you live in New York, Miami, or St. Martin. This decision could hit your wallet, your job, and your investments. Let's break it down. What the Fed is, how rate cuts work, and what this means for you, in and outside the U.S. The Federal Reserve, or the Fed, is the central bank of the United States. Its job? Two things: price stability, keeping inflation in check, and maximum employment, make sure people can work. One of its most powerful tools is the federal funds rate. That's the interest rate banks charge each other for overnight loans. When the Fed changes that rate, it influences almost everything: mortgages, car loans, credit cards, even savings accounts. And when the Fed cuts rates, borrowing gets cheaper. Spending and investing usually go up. On September 17, 2025, the Fed cut rates by 25 basis points. That's 0.25%. The new range is now 4.00 to 4.25%. This is the first cut since December 2024. And the Fed hinted there could be 2 more cuts before the year ends. Why? The job market is slowing, inflation is cooling but still high, and growth risks are rising. Translation: the Fed is trying to keep the economy alive without letting inflation flare back up. Here's how it flows through the system. The Fed lowers the cost of money for banks. Banks then lower rates for businesses and households. Borrowing gets cheaper, people spend more, companies invest more. But savers and bondholders usually lose out. Lower rates mean smaller returns on savings accounts and treasuries. And don't forget the global side. Cheaper money in the U.S. often makes the dollar weaker compared to other currencies. So what does this actually mean for Americans? Home buyers. Mortgage rates may inch down, refinancing could make sense. Borrowers. Car loans, business loans should get cheaper, though credit cards take longer. Savers. Bad news. Lower returns on CDs and savings accounts. Investors. Stocks and real estate often benefit, as money chases higher returns. Bottom line: borrowers smile, savers frown, and investors watch closely. And for the rest of the world? A weaker dollar makes U.S. exports more competitive. Emerging markets may benefit from easier access to global money. But countries tied to the dollar might see imported inflation. So depending on where you live, this cut could either make borrowing easier or raise the cost of goods you import from the U.S. But here's the catch: inflation is still sticky. Growth is slowing. And interest rate cuts work with a lag. We won't feel the real effects for months. If inflation spikes back up, the Fed could reverse course fast. If the economy slows too much, even more cuts could be coming. It's a balancing act, and the world is watching. So what should you be doing right now? If you've got high-interest debt, start paying it down. If you're a homeowner, keep an eye on mortgage rates. Refinancing may save you money. If you're a saver, look for better alternatives than basic savings accounts. If you're an investor, diversify. Don't just chase hype. So yes, 0.25% cut might sound small, but it could be the spark that shifts the U.S. economy and global markets in 2025. Stay informed, move smart, and remember, what the Fed does in Washington affects you no matter where you are. If this breakdown helped you, hit like, drop a comment, and share this video so more people understand what's happening. Subscribe for more content.